Stop everything right now. It's Friday evening, January 17th, 2026. And while you were finishing your work week, while you were planning your weekend, while most of America was checking out mentally for 2 days, something absolutely critical just revealed itself in the silver market that changes everything. We thought we knew about where this metal is headed. I'm not talking about next month. I'm not talking about next year. I'm talking about what's setting up right now, this weekend, this moment, that suggests silver isn't just going to $100. It's going to $200, and it's going to get there faster than anyone outside of the inner circle of professional traders believes is possible. Let me be absolutely direct with you because there's no time for fluff and no room for uncertainty. The technical setup that just confirmed itself this week is the same pattern that preceded every major parabolic move in silver's history. The same signature that appeared before the 1980 explosion to $50. The same fingerprint that showed up before the 2011 surge to $49. And it's here again, right now, screaming at anyone who knows how to read these charts that we're not in a normal rally. We're in the early innings of a generational wealth transfer, and most people are going to miss it because they're focused on the wrong signals. This week, silver didn't just move higher. It ripped through the $90 level like it was tissue paper, then did something that separated the professionals from the amateurs. It whipped violently intraday in a move so savage that weak hands got shaken out in a matter of hours. And then, this is the key part, it recovered almost immediately. That recovery, that ability to drop hard and bounce right back, that's not weakness. That's the market showing you it has an engine underneath that's just warming up. And when I show you the specific price target that this technical pattern is pointing to, you're going to understand why I'm saying $200 silver isn't just possible, it's probable. Here's what happened this week that most people completely missed. Using Fibonacci extension analysis, and before you roll your eyes and think this is some mystical nonsense, understand that Fibonacci levels work not because they're magic, but because millions of traders around the world use the same mathematical framework, which creates self-fulfilling prophecies in price action. The silver chart just confirmed a measured move that projects to approximately 106.25. That's the next major technical target, and we're talking about a move of roughly 15% from current levels. In a normal market, that would be remarkable. In silver, which has been moving with the kind of volatility that makes seasoned traders sweat, that can happen in days. But here's where it gets absolutely wild, and this is what you need to pay very close attention to. $106 is not the top. It's a way station. It's a psychological checkpoint. It's the level where the mainstream financial media will finally start paying attention, where your coworkers will start asking you about silver, where the FOMO crowd will start rushing in. And that FOMO, that fear of missing out, is the rocket fuel that will propel silver from $106 to levels that sound insane right now, but will seem obvious in hindsight. Let me explain the psychology of what happens at these major technical levels, because this is where fortunes are made and lost. Right now, there are thousands of traders who sold their silver positions at $85 or $88 thinking they were being smart, thinking they were locking in profits before the inevitable pullback. Those same traders watched silver climb to $92 and they felt a little uncomfortable, then it hit $95 and they felt annoyed. Now imagine what happens in their brains when silver tags $106. Suddenly they're not thinking rationally anymore, they're thinking, I have to get back in. I can't miss this. Everyone else is making money except me. That emotional response, that panic buying, is exactly what happens at major Fibonacci extension levels. It's a magnet that draws in late money, and that late money provides the liquidity and momentum for the next explosive leg higher. This isn't theory. This is documented market psychology that repeats over and over across every asset class throughout history. Now here's the part that should make your heart rate increase. The same Fibonacci analysis that's pointing to $106 as the first major target is also revealing what comes after. When you extend the measurement further, when you look at the full mathematical sequence, the next level that appears, the level that represents a complete retracement and extension of the entire move, sits somewhere in the range of $180 to $220. I'm being conservative when I say $200 silver is coming. The math actually suggests it could go higher. And before you think I'm just pulling numbers out of thin air to get you excited, let me show you why this isn't speculative. Silver has already gained over 140% from its lows in early 2025. It went from under $30 to over $90 in roughly 1 year. That's an extraordinary move, but here's what most people don't understand. Parabolic moves in commodities don't end with a gentle rollover. They end with a final surge that's even more violent than the move that preceded it. They end with a blow-off top that shocks everyone who thought the previous gains were already too much. Look at what happened in 1979-1980. Silver went from about $6 to $50 in a matter of months. That's more than 700% in less than a year. The move from $30 to $90 is 200%. We're not even close to the kind of parabolic acceleration that defines a true mania phase. And here's the critical insight. We're entering that phase right now. This week's price action, the violence, the volatility, the ability to absorb selling and keep climbing, these are the signatures of a market that's transitioning from a steady uptrend to a parabolic explosion. Let me give you the specific technical roadmap so you understand exactly what I'm watching and why I'm so confident about what's coming. First waypoint, 106.25. This is the 100% Fibonacci extension of the recent measured move. This level will likely be reached within the next few weeks, possibly sooner if momentum accelerates. When we get there, expect massive volatility. Expect a sharp pullback that scares people. Expect the financial media to call it a top. But if the pattern holds, if silver can hold above key support levels during that pullback, it confirms that $106 was just a pause, not a peak. Second waypoint, 125, 135. This is the psychological barrier zone where round numbers create resistance. $125 is a quarter of $500, which matters to institutional algorithms. 135 represents a specific Fibonacci level based on longer-term charts. This zone will be a battleground, but once silver clears it with conviction, the path to 150 plus opens up rapidly. Third waypoint, $150, $170. This is where things get truly interesting because this range represents the inflation-adjusted equivalent of silver's 1980 peak, depending on which inflation calculator you use. Some analysts put the real inflation-adjusted high at $150, others at $180s, others even higher. The point is, this zone has psychological significance because it's where silver catches up to its historical peak in real terms. Final target, 200 plus. This is where the mathematics and the psychology converge. This is where the parabolic move reaches its climax. This is where late-stage FOMO meets genuine supply shortage meets institutional panic buying. And this is where, and I want to be very clear about this, you need to have a plan to take profits, because what comes after a move to $200 will not be gentle. Now let me address the elephant in the room, the question I know you're asking. What could go wrong? What could derail this? Because nothing in markets is guaranteed, and anyone who tells you otherwise is selling you something. Here are the real risks you need to understand. Risk number one, exchange intervention. When silver gets too volatile, when it starts moving in ranges that threaten the stability of the derivatives market, exchanges have historically stepped in to change the rules. They raise margin requirements, which forces leveraged traders to either put up more cash or close their positions. This creates cascading selling that can temporarily crush the price. We've already seen this happen. There were sessions this week where silver swung 15% in a single day, and that kind of volatility is exactly what triggers exchange action. But here's the critical distinction. Margin requirement increases don't change the underlying fundamentals. They create temporary sell-offs that shake out weak hands and over-leveraged speculators. If you're holding physical silver, if you're not trading on margin, these interventions actually work in your favor because they create buying opportunities at lower prices before the next leg higher. Risk number two, a broader market crash. If we see a major stock market correction, if we see a liquidity crisis where everything gets sold at once, silver will get hit too. In 2008, when Lehman Brothers collapsed, gold and silver both crashed along with stocks because panicked investors sold everything to raise cash. This can happen again. But, and this is important, those crashes create the best buying opportunities because the fundamental reasons to own silver become even more compelling when the financial system is under stress. Risk number three, profit-taking and rebalancing. This is already happening. Dealers are reporting increased selling from people who've been holding silver for years and are finally sitting on gains they never expected. When something triples in value, it can dominate your portfolio to an unhealthy degree. So rational investors trim, they rebalance, they lock in some profits. This selling creates resistance at key levels. But here again, as long as the buying pressure from new participants exceeds the selling pressure from profit takers, the uptrend continues. Now let me tell you what's happening behind the scenes that most retail investors don't see, but that professional traders are watching very carefully. The physical market is decoupling from the paper market. This week, the premium for physical silver in Shanghai, the actual price people are paying for real metal they can touch, surged to record levels above the so-called spot price quoted in New York and London. We're talking about premiums of $10, $15, sometimes $20 per ounce above spot. Think about what that means. It means buyers in Asia aren't willing to wait. They're not negotiating. They're not playing games with paper contracts. They're bidding for real metal right now, and they're willing to pay massive premiums to get it. That kind of urgency doesn't exist in a market that's running out of steam. That kind of urgency exists in a market that's running out of supply. And here's the data point that should make your jaw drop. On a single trading day this week, the volume of silver traded in paper form, futures contracts, ETFs, derivatives, was measured in the hundreds of millions of ounces in one day. The entire global mining industry produces about 800 million ounces per year. So in a single day, the paper market churned an amount of silver equivalent to months of global production. Does that sound like a market that's accurately pricing a physical commodity based on real supply and demand? Or does that sound like a market where the price is being determined by financial engineering? The answer is obvious. And what happens when the paper market, which has been suppressing the price through unlimited creation of paper claims, finally breaks down and has to reconcile with physical reality? The price explodes. Not gradually, violently. And we're watching the early stages of that breakdown right now. Let me give you another piece of evidence that confirms we're in the early stages of something much bigger. The US Mint announced this week that it's pausing sales of certain silver products while it evaluates pricing. Translation: the input cost is moving so fast that they can't keep their pricing models current. They're worried about selling products at prices that become outdated before the transaction is complete. That's not normal market behavior. That's operational stress. That's what happens when a market is starting to lose its composure. Now, I want to talk about what happens psychologically as we approach these major price levels, because this is where most people make catastrophic mistakes. There's a phenomenon in trading called anchoring bias, where your brain fixates on a specific number and you make all your decisions based on that number. Right now, for a lot of people, $100 silver is the anchor. They think, when it hits $100, I'll sell, or when it hits $100, I'll buy, or when it hits $100, I'll know what to do. But here's the trap. $100 is arbitrary. It's a round number that feels significant to humans, but the market doesn't care about round numbers. The market cares about supply, demand, momentum, and positioning. So when silver blasts through $100 and keeps going to 106, then 110, then 115, people who were anchored to $100 get paralyzed. They don't know what to do because the script they had in their head didn't include this scenario. This is why I keep emphasizing you need a plan that's based on structure, not on numbers. You need to watch how silver behaves at key technical levels, not just whether it hits some predetermined price. If silver gets to $106 and then consolidates for weeks in a tight range between $100 and $110, that's bullish. That's the market building energy for the next leg. If silver spikes to $106 and then immediately crashes back below $90, that's a warning sign. That's potential topping behavior. But if silver gets to 106, pulls back to maybe $98 or $95s, and then bounces hard and takes out 106 on the next attempt, that's confirmation. That's the market telling you it's not done. That's when you know the move to $125, $150, $200 is still in play. Now let me address the people who are sitting there thinking, I missed it. Silver was $30 last year and I didn't buy. Now it's $90 and I can't chase it this high. I understand that feeling, but let me reframe it for you. If silver is going to $200, and I believe the technical and fundamental evidence strongly suggests it is, then buying at $90 isn't chasing. Buying at $90 is getting in at less than halfway to the target. That's still early. The people who really missed it are the ones who will buy at $175 after watching it run from $90 because they couldn't get over their mental block about it's already up so much. Those are the people who become exit liquidity for the smart money that bought early and is selling into the mania. Don't be that person. Here's a practical framework for thinking about entries. If you believe the thesis, if you believe that currency debasement, supply deficits, industrial demand, and geopolitical instability all point to higher silver prices, then you buy in tranches. You don't put 100% of your allocated capital in at once. You buy 25% now. You buy another 25% on a pullback if you get one. You buy another 25% if it breaks to new highs. And you keep the final 25% dry powder in case you get a gift, a flash crash that gives you an entry you never expected. This way, you're not trying to time the perfect bottom. You're systematically building a position while the trend is intact. And if you're wrong, if silver rolls over and the bull market ends, you haven't blown up your account because you didn't go all in at the top. Now let's talk about the exit strategy, because this is even more important than the entry. I said earlier that silver is likely going to $200. I believe that. But I also know that when silver gets to $200, if it gets there as fast as I think it might, the move will be exhausted. The parabolic phase will be over. And what follows a parabolic phase is always, always, always a brutal correction. Look at history. In 1980, silver peaked at $50 and then crashed to $10 within months. That's an 80% decline. In 2011, silver peaked at $49 and then ground down to $14 over the next 4 years. That's a 71% decline. These aren't gentle pullbacks. These are life-altering losses for people who held all the way up and then held all the way down. So here's my framework, and I'm not telling you what to do. I'm telling you what I would do. If silver reaches $150, I'm taking 25% off the table. That's 1/4 of my position converted to cash, locked in, removed from risk. If silver reaches $175, I'm taking another 25% off. Now I'm 50% cash, 50% still in the trade. If silver reaches $200, I'm taking another 25% off. Now I'm 75% in cash, 25% still riding in case it goes higher. And the final 25%, that's my moon bag. That's the position I'm willing to hold through a correction, because if silver somehow goes to $300 or $500 in a true monetary crisis, I want exposure. This strategy accomplishes several things. First, it guarantees you take profits on the way up. You're not trying to sell everything at the exact top, which is impossible. Second, it reduces your emotional attachment. When you've already locked in significant gains, it's much easier to watch volatility without panicking. Third, it keeps you in the game. You're not all in, but you're not all out. You have optionality. Now I want to talk about something that's going to become increasingly important as silver moves higher. The difference between paper silver and physical silver. Right now, you can buy silver ETFs, you can buy futures contracts, you can buy mining stocks, or you can buy physical coins and bars. These are not the same thing, and the differences will matter enormously as we move into the late stages of this bull market. Paper silver, ETFs, and futures are convenient. They're liquid. You can buy and sell instantly, but they're also subject to counterparty risk. You're trusting that the institution holding the silver actually has it, that they'll give it to you if you ask for it, that the system won't change the rules when stress hits. In 2008, some gold ETFs suspended redemptions. In various crises throughout history, futures markets have forced cash settlements instead of physical delivery. This can happen again. Physical silver is clunky, it's heavy, you have to store it, you pay premiums when you buy and take a haircut when you sell, but it's yours. No counterparty risk. No one can click a button and make it disappear. And when the paper market breaks down, when the premium for physical overspot explodes to $50 or $100 per ounce because supply is completely dried up, the people holding physical will be in a completely different position than the people holding paper. My personal allocation is weighted heavily toward physical for my long-term stack, with some paper exposure for tactical trading. But everyone's situation is different. The point is to understand the trade-offs and make conscious decisions. Now let me address the mining stocks, because this is where a lot of people are confused. The stocks have moved up, some of them significantly, but they're still nowhere near the valuations you'd expect with silver at $90. Why? Because the market doesn't believe it yet. Institutional investors, the big funds that move billions of dollars, they're waiting for confirmation. They want to see multiple quarters of earnings that prove these companies can actually generate the cash flows that the current silver price implies. But when those earnings start hitting, when the reports come out showing profit margins of 60%, 70%, 80%, the re-rating will be savage. Mining stocks can move 5x, 10x, even more in a true commodity mania because they provide operational leverage to the underlying metal. If silver doubles from $90 to $180, a mining company with fixed costs might see profits increase 5x or 10x, depending on their cost structure. That's the opportunity. But it comes with risk. Mining stocks are volatile. They're businesses with management teams, operational issues, political risks, dilution risks. If you don't understand those risks, you're better off sticking with physical metal or ETFs. But if you do understand them, and you're willing to do the work to find quality companies, the potential returns are exponentially higher than the metal itself. Now here's what I'm watching for next week, and this is critical. Silver is going into the weekend right around the $90, $92 range. The first thing I want to see on Monday is whether it can hold these levels or whether we get a Sunday night futures dump that tries to push it back down. If it holds, if we open Monday with strength and start grinding toward 95, that's confirmation of momentum. The second thing I'm watching is gold. Gold has been moving in tandem with silver, and the gold to silver ratio, how many ounces of silver it takes to buy 1 ounce of gold, is starting to compress. Historically, when this ratio gets below 71, it suggests silver is outperforming. Right now, we're around 50.1. If that ratio keeps compressing toward 40.1 or lower, it means silver is in full catch-up mode, and the upside acceleration could be even more dramatic than the technical targets suggest. The third thing I'm watching is the stock market. Right now, stocks are still relatively strong, but they feel fragile. They feel like they're running on fumes and momentum rather than fundamental conviction. If stocks roll over, if we get a sharp correction in equities, it will temporarily drag silver down too because everything gets sold in a liquidity crunch. But that would create the buying opportunity of the year because the fundamental reasons to own silver become even stronger when confidence in the financial system is shaking. Let me give you the game plan in clear, simple terms. For new buyers, if you're not in silver at all, start building a position now with 20 to 25% of what you want to ultimately allocate. Wait for any pullback to add another 25%. If price breaks to new highs, add another 25%. Keep dry powder for a potential flash crash. For existing holders, if you're sitting on big gains, consider taking some profits at the technical targets I mentioned, $106, $125, $150, $175, $200. Don't try to sell it all at the top. Sell in pieces and de-risk your position while keeping exposure for the upside. For traders, watch the technical levels religiously. If silver breaks $106 and holds, that's your confirmation to add. If it breaks back below major support around $85, that's your signal to step aside and wait for the next setup. Don't fight the tape. And here's my final message, the thing I want you to remember when you look back at this moment 6 months from now. We are living through a once-in-a-generation repricing of monetary metals. The fundamentals, currency debasement, supply deficits, industrial demand, geopolitical instability, all point in the same direction. The technicals, Fibonacci extensions, momentum, volume, all confirm the same thing. This is not a normal rally. This is the beginning of a parabolic move that could redefine what people think is possible in the silver market. Silver at $200 isn't a dream. It's a mathematical projection based on patterns that have repeated throughout history. The only question is whether you'll have the discipline to capture the gains and the wisdom to protect them when the move is done. Because it will end. All parabolic moves end, but between here and there, between $90 and $200, there's more wealth to be created than most people will see in a decade of traditional investing. Don't let fear or doubt or conventional thinking rob you of this opportunity, but also don't let greed or FOMO or ego destroy you on the other side. Have a plan, execute the plan, adjust as needed, and remember, the market doesn't owe you anything, but it will reward preparation, discipline, and respect for risk. The roadmap is clear. The targets are identified. The opportunity is here. What you do with it is entirely up to you.